Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I want to talk about the pros and cons of tracker mortgages. You see, now is a time where lots of people are now considering tracker mortgages. Over the last 2 years that we've run this channel, I didn't think that they were particularly good, particularly when rates were going up. You see, if you were on a tracker and the rates were going up, your mortgage rate could have gone up as much as monthly. We had 14 consecutive interest rate rises when we had the peak of inflation. But now there is maybe some opportunity to get a tracker mortgage that could save you some considerable money, but also you've got to take into account the risk of what if inflation comes back and mortgage rates go up as well. So we're going to talk about all of that and more in this video. If you're new around here and you haven't done already, do subscribe to the channel over there and hit that bell notification. We're at 33,000 subscribers we hit this week, so thank you to everyone that subscribes. And I think this video could be particularly useful to lots of people. So let's get some more views on this video by smashing like, tickling like, doing something to that like button. That really helps with the YouTube algorithm, and that will get more views on the video and let more people know about this. So, trackers. Well, they can be good if rates are moving, and rates are looking like they are likely to move down. Now, the markets expect that the Bank of England will cut rates twice in 2025. But Andrew Bailey, he's doing interviews and talks at the moment. He's saying, which is not really what they often talk about, he's saying that they will cut at least 4 times in 2025. So that means if you were to take a tracker rate today, your rate would likely get cut 4 times in 2025, which would be a nice little bonus. But on the flip side, we've got things that we've also got to consider. Inflation went down to 1.7%, then it's roared back up to 2.3%. There is still uncertainty around that. In one camp, people say inflation is here to stay. In other places, people are saying it's going to drop off. So you need to do your research and understand that. What I'd also say is when you're considering any type of mortgage product, you should always go through a broker. A broker's got your best interest at heart. They are financially regulated. They will know the pros and cons of your income, of your scenario, because a tracker is not really something that you should consider if the rates went up, if it would cause you massive financial harm. So that's a consideration. So let's have a look at the pros and the cons of trackers at the moment. So the pros are you get immediate cuts. What does that mean? Well, it's likely that you're going to get some interest rate cuts in 2025. So as they happen, then immediately you will get cuts to your mortgage the next month. So it happens very, very quickly and it's automatic. You don't even have to do anything. The lender will automatically do that. So that's a pro. So if you feel rates are likely to go down, which a lot of people do, the Bank of England are saying they're going to go down, that would definitely benefit you. Another thing is that you have a shorter tie-in. So let's talk about that. So when you take a mortgage, 2 years, 5 years, there's always some sort of penalty if you leave. Lenders want you to see through that 2-year or 5-year term. And if you leave, the earlier you leave in that deal, so let's say you take a 5-year deal and you leave in the first year, you might pay as much as 5% of all the borrowing. So if you had £100,000 mortgage and you left in the first year, you might pay £5,000 just to get out of that deal, which is quite expensive. And then it would be on a sliding scale. It might drop by 1% each year. And if you left early in the last year, you might just pay £1,000. Now, with a tracker mortgage, because there is variables in there, they are open to not having these massive penalties if you leave. And so you can shop around and look at different lenders and stuff like that. And you'll be able to find someone that doesn't have these prohibitive lock-ins. Some don't have any at all. And that's a consideration here. So there's some pros on that. The cons are the opposite. So immediate increases. So what does that mean? Well, it means if the Bank of England increase their rate, that your rate is also going up. It doesn't mean if that lender increases the rate, it's tied to the Bank of England here. So if your lender puts rates up, which some of them have been over the last few weeks, you won't have an increase in your rate. It's nothing that they decide. It's based off the Bank of England rate. So if the Bank of England put rates up because inflation starts roaring back and they're trying to control that again and get it sorted, then your rate would go up immediately on the next monthly payment, which could be a shock for people. Now, if something catastrophic happened, like inflation, like we just recently had, and we had 14 consecutive increases, there would have been some people on tracker mortgages during that time that would have found that absolutely brutal. And hopefully they quit that deal and went on a fixed deal with somebody else. So that's one thing to consider here. And the other thing is that if you do need to leave it, you will have to pay a repayment charge, but it's not going to be huge, right? Some of them don't have it at all, but there will be some sort of charge. So let's have a look at one rate on a tracker and see how it looks. So Nationwide have a good deal at the moment. They're very competitive, Nationwide, at the moment. They've got Virgin Money, they've got the Mortgage Works. Those are some of the brands that they operate under, and Nationwide, obviously. So Nationwide's tracker rate at the moment on a 2-year deal is 5.04% currently. The fees are $9.99. And how do they price that? Well, it's 0.29% above Bank of England base rate. Above the Bank of England base rate. So whatever the Bank of England base rate is, they chuck 0.29% on top. Now, if next week the Bank of England cut rates, you will get that immediately. You will get that immediately passed on to you. If they cut 4 times next year, you'll get that. If they cut 10 times next year, you'll get that, whether it's a small cut or a big cut. So that's very, very good. How does that compare to their best fixed rate deal? They've got a deal at the moment for 4.84% with the same fees. So while that's slightly higher, what you're taking here is the gamble that you believe and the market believes, which a lot of people do, that this rate will come down. So this is a 2-year deal, but let's just say the Bank of England drop by 0.5% over the next few months. You will then be in a better situation than this deal here. And if you feel that they will cut by 4 times next year, it will be even better than taking this deal. But as I said, you must only look at a tracker deal if you can afford the opposite to happen. If the rates are going up, you're going to have not be tied in, but you can leave. Maybe there's a little penalty on that, but you will need to leave. And the time it will take for you to get a new mortgage, you've got to understand you will be paying the higher payments. So that's the pros and cons of trackers. I do think they are something to consider now because rates are looking like they're going to go down. They're not looking to go down as fast as people were expecting in 2025, but it is likely they're going to move in a downward trend. Let me know your thoughts, questions, observations, or opinions in the comments below. Keep them kind. Do subscribe, do smash like, and share this video with someone. I'm sure you know somebody right now that is looking to remortgage. And check out all the other content on my channel, including this video right here.